What if you could trade the movement of the NASDAQ without choosing a strike price or worrying about time decay? That is one reason many traders become interested in futures. A futures contract is simply a contract that follows the price of a market or asset. There are futures for the NASDAQ, the S&P 500, gold, oil, currencies, and even Bitcoin. You are not buying the actual companies or products. You are trading whether the price will move up or down. If you think the market will rise, you can buy. This is called going long. If you think the market will fall, you can sell. This is called going short. If the market moves in your direction, you may make money. If it moves against you, you may lose money. Compared with options, futures are more direct. With options, you usually choose a strike price, an expiration date, and pay a premium. The value can also change because of time decay and implied volatility. With futures, your result mainly depends on how far the market moves and how much each point is worth. Let's use the NASDAQ as an example. Two popular contracts are NQ and MNQ. NQ is the larger NASDAQ futures contract. Every 1 point move is worth $20. MNQ is the smaller micro contract. Every 1 point move is worth $2. So if the NASDAQ moves 10 points, one NQ contract changes by $200, while one MNQ contract changes by $20. That can be a profit or a loss depending on your trade. You may also hear the word tick. A tick is the smallest price movement. NASDAQ futures move in steps of 0.25 points. For MNQ, one tick is worth 50 cents. For NQ, one tick is worth $5. The most important part is risk management. Before entering a trade, decide how much you are willing to lose and where your stop loss will be. For example, if you trade one MNQ contract with a stop loss 10 points away, your risk is about $20. Two contracts would risk about $40, and 5 contracts would risk about $100 before fees. Futures can be useful, but they also use leverage, which means profits and losses can happen very quickly. Before using real money, practice on a simulated account and learn how each contract works. In trading, protecting your money is just as important as making it.